In all of our examples up to this point, Bea and Arnold were focused on one aspect of an option contract. They were either buying or selling. Again, we don't recommend that any ROI user enter a trade from one and only one position. Rules 3 and 6 exist to ensure you avoid this mistake. So, if you're not supposed to just buy or just sell a call or put, how are you going to invest in options? The answer: option spreads. Also known as verticals or covered calls and covered puts, spreads protect your investment and limit your overall risk. Remember, successful investing is all about managing your risk. We're going to start with buying or going long on a call option spread. This is a great strategy to use when you're bullish on a stock, but you still want to hedge your investment. A call spread has two primary results. You manage your risk by lowering your maximum loss, and you limit your profit. Let's return to our original call option example. Arnold paid Bea a $100 premium to secure his right to buy her record collection at $10 an album over a 5-year timeline. Arnold is the buyer in this call option contract. He's paid the premium, he's secured his rights, and now the only thing to do is wait to see what happens to the album's value over the next 5 years. That said, $100 is a lot of money for a fledgling investor. Arnold wants to turn a profit, but he's also intent on lowering his initial investment. So he decides to make his investment a spread. Once Arnold pays Bea the premium, he walks down the street to a local used record store. The store owner, Jolene, is keen to buy the collection for $15 a record. She's even willing to pay Arnold a premium of 80 cents a record, or $80 total, for the right to buy the collection for $15 an album in 5 years' time. Arnold is now part of 2 option contracts. In the first one with Bea, he's the buyer. He paid her a premium to secure his rights to purchase her record collection. In the second deal with Jolene, he's the seller. Arnold collected $80 from her to hedge his investment. Arnold bought into one contract at a low strike price in the money and sold another contract at a higher strike price farther out of the money. The strike price he bought each record at is the low strike price, and the price he sold at represents the high strike price. Arnold's initial investment is the $100 premium he paid Bea. When he sells the option on that collection to Jolene, he makes $80. This second deal lowers his initial investment and maximum loss of $100 to $20. This $20 is called a net premium. As the buyer in this spread, Arnold ends up with a negative net premium. That premium, net or otherwise, represents his maximum loss. Along with decreasing his maximum loss from $100 to $20, Arnold also places a ceiling on his maximum profit. It might seem counterproductive to limit his potential profit, but entering a spread is one critical way savvy investors use options to manage their risk while generating consistent profits. When expiration day arrives, Bea's record collection is worth $20 an album. Arnold purchases the collection for $10 a record, or $1,000 total. Add the initial investment of $20, the net premium, and his out-of-pocket expenses have reached $1,020. Arnold returns to Jolene's record store, and she's more than happy to exercise her right to buy the albums for $15 a piece because their current value is $20 each. Arnold sells the collection to Jolene for $1,500. Subtract his initial investment of $1,020 from the $1,500 he got from Jolene, and Arnold earns $480 as a result of buying a call spread. In this case, Arnold started by investing $20. At the end of the contract, he earned $480. That's a 2,400% return on investment. Not too shabby. Time to look at how a call option spread plays out on Wall Street. A stock you want to invest in is trading at $50. You're confident the stock's value will increase to $70 in a few months. So you buy a call option at a $55 strike price for 25 cents a share, equaling a $25 premium. Remember, in this call option, $50 is at the money because it's at or near the current trade price, and $55 is out of the money because it's higher than the current trade value. At this point, you're the buyer in a single call option contract. To turn this single call into a covered call, you'll need to sell another contract at a higher strike price farther out of the money than $55. Remember, the farther out of the money we go, the lower the contract's premium. Therefore, a contract at a $60 strike would offer a less expensive premium than a contract with a strike of $55. The price per share on a contract at the $60 strike costs 20 cents a share or $20 total. Now, just like Arnold, you're part of two option contracts. In the first, you're the buyer, going long on a contract at the $55 strike for a $25 premium. In the second, you're the seller, shorting a call contract with the $60 strike price and collecting a $20 premium. As a result, your initial investment goes from $25 to $5, or 5 cents a share. Remember, as the buyer, that $5 net premium represents your maximum loss. Now it's time to calculate your break-even. When buying a call spread, you calculate your break-even by adding the strike price you bought and the net premium you paid per share. So, in this case, you're making money once the stock rises above $55.05. If the stock is still valued below your break-even price at expiration, you'll realize your maximum loss. In that case, there's no incentive for you to collect the stock from your seller on the first contract. Likewise, there is no incentive for the buyer of the second contract to exercise their rights, so the position closes with a $5 loss. If the stock is trading at $60 or higher, you'll earn your maximum profit. To do so, you exercise your rights to buy at a price of $55 a share. That costs $5,500. Your out-of-pocket expenses are now $5,505. That closes out your first call contract. The buyer you sold a call to exercises their right to buy. That's great news for you because you have 100 shares of stock ready to sell. To settle the second contract, the third party pays you $6,000 for the 100 shares you just purchased in your first contract. As a result, you've generated your maximum profit of $495. Here's another way to look at that. You paid a $5 net premium and ended up earning $495. That's a 9,900% return on investment. Those are the basics of buying a call spread. You buy a contract at one strike price and sell a contract of the same stock with the same expiration date at a higher strike price. In doing so, you lower your cost and clearly establish your potential profit. In the next video, we'll talk about selling a call spread.